All right, so I'm with Morgan Lekstrom of NexGold, NEXG on the TSX venture. And this is kind of a new company. I mean, it's not new, but it is new. It's a company name change and a consolidation of two existing companies. So Morgan, you're the president of NexGold, and you were also the CEO of one of the companies that got merged into this. So tell us about this combination. Tell us how it came together, and tell us everything.
Thanks.
Hmm.
Yeah, look, it was a lot of work over a very long time. It took probably 6, 7 months to put together. It came together just very organically. It's almost it's almost one of those fairy tale stories where you have shareholders on both sides that are similar. You have other people through just connections in the industry saying, "Hey, Frank's really good at these buy build strategies. Have you looked at Treasury Metals? They have a rock star builder team, and you guys have, the capital markets and the finance and also some builders in your team and exploration. Like, have you guys looked at this?" And so we started to deep dive on it. And as they deep dived on us, that didn't sound right. As we did our deep dives and our due diligence, the the key thing that came out of this was Frank's strategy of buy build needs expert builders. When you put Jim Gowans, who's chairman, arguably the probably most notable mine builder in Canadian history, you have Jeremy Wythe, who is 35 years building mines across the world successfully ahead of schedule under budget and has done it many times in Canada. And then you have our capital markets team. Myself, I've built mines around the world. I've been in the capital markets for a number of years as well. It really seemed natural. The assets, they look unsimilar, but the Ontario asset for Treasury, 3 million ounces of gold. The Alaska asset for Black Wolf when we merged was about 840,000 gold equivalent ounces. Treasury's asset permitted federally, going through the provincial part, and on the bottom of that Lassonde curve, which was unfortunate companies get there. And we're about 18 months away from shoveling the ground, and we can talk about that later. But it was such a unique opportunity for entry for both companies that when we combine them and recapitalize them, it gave us that growth platform that we're really looking for. And that is to become a leading mid-tier consolidation and production company utilizing our experts.
All right, so I do want to talk about the company's projects and
Sure.
the assets, but first let's talk about the share structure. So let me get this right. There's now roughly 76 million shares outstanding, and how many warrants and what are the strike price on those warrants?
Let's go to those. They're a little bit all over the place. About 65, 70% of those warrants are at a strike price of 84 cents. We're trading at $1.07 right now. And those are held by Extract generally. So you have a very strong long-term shareholder there that could convert, and they'll create no overhang in the market, which is nice. You have a majority of the other warrants held by Sprott and Frank, and those are up in the $3.36 range. So again, you have the ability to convert with almost no overhang in the market. So you got about 16 million warrants outstanding that could bring in significant amount of dollars, and the market wouldn't see it on the stock. So that's a really unique position to be in, having almost all your warrants held by insiders insiders in close relations with the company at this stage.
Okay. And so Frank Zustra is currently the largest shareholder, but with the warrants, he might not be the largest. Is that right?
Yeah, I would say Extract Capital is the largest shareholder currently on a partially diluted basis. Frank is second. Actually, I think Frank and Sprott are very, very close in there. So altogether, between all the different groups and insiders and close people, we control about 40% of the company, of the share float, for
So
a
six,
company that's been around for a long time.
so 16.4 million in cash. That's a really good place to be in, to have that much cash in the treasury. So let's talk about the company's projects and what are you going to do with the cash?
Yeah, so I'm going to forward through to the project so we can talk about it on your screen here. you know, having 16 million in cash is a very good position to be in. Obviously, we've split the company kind of into two directions now. One, continuing down that path, that curve of finalizing the permitting, getting to construction decision, and then moving into building that 110, 120,000 ounce per year producer that Goliath will be. But secondary is a dual strategy. It's exploration and putting significant dollars into that. And we're doing that because, you know, there is a huge focus on obviously development, but there's a massive area here, a 65-kilometer strike, with the two main open pits being 25 kilometers apart that feed the mill, or that will feed the mill. There's a huge amount of exploration in between there to be done. There's an area called Inner Lakes, and you'll see coming out from us in press releases over the next little while about our exploration plans. But that area is wild. The whole area is wildly underexplored. There's been sparse drilling. There's been, you know, a little bit of drilling here and there, but you have, again, 25 kilometers between two open pits in the same geology, same rocks. There's got to be something there. You have the two pits, Goliath and Goldlund, and Goliath has a small underground. Both are open at depth on strike. So it just made sense. Look, we're going to create a year and a half of news flow out of exploration and start to show the district scale potential, which we believe it is. You know, you have 3 million ounces now, and as Frank likes to say, let's get it to 5 or 10. So 65 kilometers gives you a lot of room to do that. So we're going to put a significant focus on that while Jeremy and the team, you know, with Jeremy's expertise, run to ground the construction and get moving on that. So expansion through that. Also on the project, it's already 3 million ounces between the two open pits. You know, we think we can add higher grade ounces as well as more ounces to it in a very short period of time.
Okay, so this is pretty impressive. You already have 3 million ounces. You've got 2.1 million in the M&I category. How big could this be? I mean, when you guys got together and decided, okay, we want this asset, what was your conversation in terms of how big you think this could be?
It's interesting. It was the conversation really focused at start around how do we get it to production? And then over time it turned, you know, we sat with Frank and we sat with their chairman and their group, and it was really Frank that looks up and goes, that's a big strike. How big can this be? And that's when the conversation started. And we go, well, I mean, it could be 5, it could be 8 million ounces. We just haven't really explored for that yet because we've been, you know, as a company focused on getting this to the build stage. That's exciting. It's a very large land package, and it's a very large strike. I was there on Tuesday, and you know, by the time you drive it all, you're a full day, and that's just driving the exploration targets, let alone Goldlund and Goliath. So you have huge potential there. Again, the grades are going to be most likely similar. You know, you're not on the high end of an open pit, and you're not on the low end of an open pit. What I like to say is you're on the lower capex, below $400 million. You're on the lower risk side of the projects, open pits, CIL, circuit, mill, 7,500 tons per day. You're on that scale and that quantum where when you add ounces, like we think we can do, and add these discoveries, it just prolongs that mine life significantly. You add grade, you up the ounce count per year. So it's really an interesting lever now that we're going to start pulling on.
So to get a gold, deposit or 3 deposits to these categories requires a lot of drilling. So I'm just curious, how much money has been invested here in the past? Like, what's the total spend that you basically acquired?
Yeah, look, I would lie if I gave you the exact number because it's been many companies over many years doing it. But to get projects like this to that size and that scale in the M&I category requires probably $100 million.
Yeah,
And when
that's
you
what I was
think
thinking.
about 100 million on the quantum, and you think about the value of the company right now, it's 76 million dollars, with a project that at 2150 gold has a 650 million NPV and a under 2-year payback with a 42% IRR. You're thinking, okay, someone's put a lot of money into this over the last 15, 20 years. And wow, it still has expansion potential, and we can build it. So there's a lot of advantages to where we've entered this company, the phase of this company now.
Okay, so this is the flagship here in Ontario. What's next?
what's next for the Ontario project, or what's
Well,
next?
there's more projects in the company, right?
There are, there are,
Okay.
there are other projects, but let's talk about what the plan for the company is.
Okay. Okay.
And that's the vision. So we have this Goliath project. We're running it into construction. That's 18 months, boots on the ground, 18-ish months. Now, the vision for this company is really going after this subset market that doesn't, no one exists in it right now. Caliber left the mid-tier space when they bought Marathon. They're now becoming that bigger mid-tier. Those 100,000 ounce per year producers are just, or projects are kind of left in the wing. They're sitting in, single asset companies and stuff like that. So our vision is to go after projects sub 400 million capex, between 80 and 120,000 ounce per year, low ASIC, and use that team of expert builders with Jeremy Wythe, Jim Gallons, and that team to put them into production. We want to create a pipeline of producible, buildable assets to get to between 3 and 500,000 ounces per year in the next 5 years. And it sounds lofty, but when you have someone like Frank who's done this over and over and over, and people like Jeremy and Jim who built these over and over and over, it starts to make sense really quick. And there are assets in the industry that will help with that.
Okay, so you're following a buy and build strategy, and you're really set on building a mid-tier gold company, focused in Canada.
Focused in Canada right now, for sure. Again, I think people tend to get good, and then they leap, right? I want our company, and I think Jeremy and the vision for this company as well is to get exceptionally good at building 100 to 120 or 80 to 120,000 ounce per year producers. Because when you do that, and on a business side of things, you de-risk the business. You have multiple mines going, lower costs. You don't have a risk of a one mine fail scenario, which we've seen over and over in this industry, and not knocking it. It's just, it does happen. Grades change or something changes. That is the idea, is a de-risked, high leverage business with multiple assets.
So, so that then takes me to the question of how do you acquire new assets, and what do you look for in terms of, an attractive project? How big does it need to be? What are the top factors that you look for when you're reviewing a new asset for a potential acquisition?
Stage of the resource. So what category it's in, it mostly indicated, which means someone spent a buttload of money getting it there, like we've just spoken about. Stage of permitting. We ideally want things that are past the EIS or old EIS, but EA phase. They get into that dev curve where they're in the bottom of the Lassonde curve, and it's really hard to pull out of that. Those are opportunities for us, given what we have now and how we're kind of coming out of that Lassonde curve. The ability, ideally at least 1 million ounces, so 10 years of 100,000 ounces per year, ideally, or 80 to 100, however that curve works. And honestly, location to infrastructure. I mean, when you look at Goliath, for example, the high voltage power lines run right through the property, and it's 15 miles out of Dryden. So you have infrastructure, you have locality, you have support. Obviously First Nations is a huge component to this. You want to have great First Nations relations in the area. So there are a number of assessments we do when we're looking at projects, but I think you'd be surprised at how many projects get to this phase of permitting, and it's unfortunate because it's actually such a critical phase that there should be so much excitement around it. You can get these things through permitting, but again, they don't have that news flow and appeal that we're going to start bringing back to Goliath and to Goldlund and to our projects here, because it takes a lot of focus and a lot of money and time to go through these phases. So I like to look for value, and that's really what it is. They're at a bottom of a valley. They're in the bottom of a curve on a stock value, and then starting to be a good value on an accretive transaction, right? You bolt together 3 companies and you got, 300,000 ounces per year in 5 years with a clear path. Your investors know what they're looking at now. They know that there's expansion potential. They know that we can build it because we have the ability. So I want to give investors a lot of confidence in what we're doing and how we're creating that pipeline.
Yeah, I like the strategy because I know there's a lot of assets that are out there that meet the criteria that you're looking for, and they're sort of unloved. There's a number of, I mean, I was just looking at the map in this area of Canada, where you're focused right now, and there's some publicly traded companies that have big projects in this region. So there's a lot of low hanging fruit. Maybe you can roll up a number of assets in this, the same region. Okay, I like the strategy. I like the team, that you've assembled. What do you do with the other assets? I guess now the company has some sort of non-core projects. What will be done with those?
So I'll answer that question in 2 seconds. And I brought up a slide just to kind of resonate that thesis of what we're talking about being the go-to investment growth platform. And that resonates into our other assets as well. Between the two assets now, we have about 3.8 million gold equivalent ounces, almost 4 actually, gold equivalent ounces, with a little bit of copper on the Niblack side. Look, the assets that Black Wolf brought into this, Niblack, and I'm going to forward to that here quickly, because we're bouncing around a bit, but is a near-term potential production asset. It has a fully developed underground. It has fully built infrastructure. And through this transaction, we got rid of any low-hanging debt on it as well. So we bought the camp full out, which was a very accretive move for this. It puts the project in a build and production potential state. We settled out any of the tech stuff, and they were very happy to come on. It was supposed to be a cash settlement. They're very happy to come on as a shareholder as well. So you end up getting these types of shareholders in through this. Look, Niblack is a 45% of copper and 45% of gold balance on it. It's got a 6 million ton resource on it with about a 2 million ton, and this sounds small, but high grade core, like $600 to $800 per ton core. When you think about that, I always like to preface this to people. Just because it's huge doesn't mean it's profitable, right? You can have an 80 or 100,000 ounce per year gold producer make way more money than a 300,000 ounce per year gold producer with way less risk, because their ASICs are lower and their project is just longer, more sustainable, and less potential issues, right? So that's when I look at Niblack, I go, yeah, it's 2 million or 6 million tons. We could probably direct ship 2 million very quickly and cash flow out of it. But I look at what's going on in Alaska with Contango and High Gold. We're on that kind of same trend. We're just down from Greens Creek. That asset has leverage to it. It has a high grade copper core to it and gold core. So no, I'm not looking at offloading it anytime soon. We've got the burn down on it very low, so just into sampling and the regular stuff that you have to do. But it does fit the pipeline. We could produce out of it in a short period, but it also creates an M&A opportunity for people in that area. So again, there's dual leverage into the buy build pipeline. It's probably further on in that pipeline, but I think you're going to see an Alaska roll up, and we're going to be able to get a lot of value out of it, given now where it sits in our portfolio.
Okay. Yeah, I mean, you're right. You make some excellent points there. I mean, it's pretty high grade. You've got 4 different metals, in the resource there. And it's 6 million tons. I mean, obviously you'd rather it be 20 million tons, but it is what it is. I think a lot of investors think, well, if it's not really big, then a major won't be interested. So that caps the upside. What are your thoughts on that? I mean, yeah, it's not big enough for a major, but it could be big enough for a smaller miner, right?
Yeah, and given its location, it's in Southeast Alaska on the Prince of Wales Island. It literally sits right on the water. Like, you walk 250 meters, 300 meters from the portal, and it's pretty sloped, and you walk in there and you're on the ocean. You've got a barge offloading ramp. Like, again, great infrastructure for shipping. I think the argument of the major argument, like, I've worked for companies like Freeport in Indonesia. I spent lots of time with Rio Tinto in Mongolia. I put mines in production in Africa, and I've seen these different things. Like, majors that go after massive assets like the Rio Tintos and the Freeports, they're massive. They're not in a junior. I'm going to tell you that right now. Like there's very few times you see a major company go to a junior and say, thanks, I want your asset.
Mhm.
It's just not far along
It
developed. It's not
happens
developed
like
far enough.
once a year, maybe.
Yeah, maybe once a year. And that's more to the mid tiers. They pluck a mid tier,
Mhm.
right? Like you don't see a $40 billion company going to a $300 million company and saying, hey, thanks, sweet, you're going to make a material difference in our portfolio,
Mhm.
right? They go to a New Gold or a Caliber and they say, okay, you've got 500,000 ounces per year. Now you can come in, right?
Yeah.
Again, but it's a risk profile. This is why for us, I love this strategy because no one's almost no one's doing it. And it's been tried, tested, and true. Caliber did it, very tried, tested, and true. And I like their model. Frank's done this over and over and over, tried, tested, and true. There's times in the market where you get a counterbalance. You have majors not looking to buy projects that are, you know, on the incrementum of like less than 400,000 or 500,000 ounces per year. And you have mid tiers that are operating in that 400,000 to 500,000 ounce per year range. So there's this fulcrum point happening. And underneath that is a swath of opportunity. And yeah, maybe we won't get bought out by a major. I'm not concerned about that because mid tiers like Kinross and other people look at projects that are, $500 million, $2 billion. That's still a significant win for shareholders, right? Just because you don't get bought out by a major doesn't mean you can't have a major win.
Got two more questions for you, Morgan, and then I'll let you go. What can shareholders expect in terms of news flow for the next 6 months or so? You got 16 million in cash. Seems like you got your work cut out for you here. Yeah, what's the news flow?
So we're going to start going back into this exploration phase. Start exploring. I'm going to highlight here in between this Goldlund and Goliath, and you'll see news releases coming out on that. We'll have news flow from drilling most likely the next 12 to 16 months. You're going to have news flow coming from the permitting, IBAs, the feasibility study. You're going to start seeing this news flow and catalyst just starting to compound. I wouldn't rule out M&A as a part of that news flow and in the short order. I think that, look, you have a company that hasn't been exploring for a long time that's going back there going, we've developed targets for 10 years. I was on the boots on the ground with the director of exploration, Adam Larson. I'm like, what's the most exciting target? And he's like, I mean, where do I start? He's like, we can do down dip on each project and it gets higher grade, or we can go to this Inner Lakes target. I'm like, tell me about that. And it's perfectly between Goliath and Goldlund. Past sampling results, ultra high grade, never drilled. So huge potential for new discovery as well. While we continue down that lower Lassonde curve permitting path. So kind of running I'm using my hands here, but a dual path to get leverage into the market and show investors that, hey, we're here, we're finding more ounces, we're finding higher grade while we get this thing to a build phase. So there's a lot
So,
coming.
so you're gonna have like two things going on. You're going to be doing permitting and feasibility work, and you're going to be advancing that. Most investors in the junior mining sector kind of yawn at that, although it's hugely important and it adds value to the assets.
Yep.
There's really no other way. You can't operate a mine unless you have permits and you've done a feasibility study. But at the same time, you're going to be doing new exploration work on some targets that are untested, maybe some low hanging fruit there. That sounds interesting. That there's a big soil anomaly right in between the two deposits along. I don't know what that strike extent is, but it looks pretty massive.
65.
25,000 meters.
Yeah, it is. It's a 25-kilometer strike, but just between the pits and another
Uh-huh.
between the Miller deposits, 35. So the whole strike being 65. Yeah, you're right. And I emphasize to say this. I mean, the feasibility and the permitting are well underway. Those are looking to come out, and I should probably show you the development timeline by early to mid 2025. By Q3, we're making a construction decision, and by the start of 2026, I'd like to have a shovel in the ground. So
Wow,
fairly accelerated.
that's pretty aggressive. So freeze that. I'm gonna take a screenshot of that. If we go back and look at this a year from now, is it gonna look different?
You know what? Leading up to this, I would say, if you asked me 5 years ago and I was involved with this company, it would be if like maybe not. given the state and where Jeremy and the team have taken this and the amount of information they've already put together, I would say that's barring any natural or political disasters, this is a very realistic timeline.
Knock on wood.
Yeah,
Knock
no,
on wood.
agreed.
Okay, final question. So I was at the Full Symposium yesterday and Tuesday, and I had an hour-long conversation with Matt Geiger. You know, he runs a hedge fund out of California, focused on the junior mining sector. And he said one of his favorite questions to ask company management is, what are your shares worth? What are your shares worth? So I'm going to ask you, what are your shares worth and why?
What are my shares worth and why?
Yeah, it's a tough question.
It's an interesting question. I'm gonna counter it for 1 second with something that I heard recently when I was in Europe marketing, and I actually loved this. Retail investors always ask this question, and I'm sure you will be able to resonate with this: is how much does management own? You know, it goes to play towards what are your shares worth? I always think that's the wrong question. I think the question that should be asked, and what was brought up to me is, you know, I'm 39 years old and stuff like that, is how much of your net worth is tied up in this company?
Yeah, that's a good one. And he asked that one too. Yep.
And if you ask me, 50%. Like
Okay.
I've given up change of controls, I've got more RSUs, I've continually buy shares. You'll see I will continue every week buy shares. My, 50%, I have a 6-year-old son, so that's I need to balance it a bit, but that's a lot. And I plan on making it more. So to me, what the shares are worth are a vision, a platform of growth. Those shares have a very large value to them as we increase the value. This company has been over $200 million market cap before off of just one project. Now imagine with Frank and the team and the expansion that we're going to do. So when you ask what the shares are worth, I think they're worth right now, if you ask me, to where they're going to be low compared to where they should be, especially compared to NAV. I mean, we're trading at about a 0.1 to our MPV of our asset, which most companies in this stage of it trade at 0.2. So there is a potential re-rate in our share as well. So it's worth a lot to invest.
Yeah. That's an interesting one. And that I'm glad you brought that up because there was a presentation as well on Wednesday at the Rural Symposium talking about the enterprise value per ounce of a company in the exploration stage. About $30 per ounce is the peer group average. Now, obviously, that's not pure exploration because you have a resource. You're a little bit past that. You might still be doing some work to explore and build the size of the project. But if you've got a resource, then you're a little bit further along in the feasibility process. So $30 an ounce. So you have 2.9 million.
Total
Uh,
between projects, we're at 3.7 million all in.
So 3.7, so times 30, you could just do ballpark 100 million, but that's in US dollars. So you do the Canadian exchange rate, 135 million. So investors can do their own math and determine if $30 an ounce is the right price or not. And then when it gets to a producer stage, the peer group average is $163 per ounce. So there's a huge rewriting process that occurs there as a company ramps up and gets their final permits and builds the mine. Great conversation. Morgan, I really appreciate it. It's a great introduction to the company NEXG on the TSX Venture. And I look forward to more conversations, with you in the future.
No, I appreciate it. Thanks again.
Cheers.